Hello, today is June 2nd, 2021, and thank you for joining me for another edition of the Market Commentator podcast. My name is Andy Wilms, and I am the President and CEO of the Milwaukee Company. Joining me this morning, once again, is my co-host Jake Wilms and Jim Picerno, who is the Director of Analytics at the Milwaukee Company. Today, Jim, Jake, and I will be discussing the U.S. dollar and its outlook. But before we get started, please keep in mind that this podcast is for informational purposes only, and that the views expressed in today's podcast are Jake and my personal views and not necessarily those of the Milwaukee Company. Jake, I'm going to turn it over to you this morning.
Thank you very much, Jim. Thanks for joining us on the podcast. Happy to have you.
Good to be here, Jake.
So I think the best way to begin is to just start right in and start talking about the dollar. I've seen commentary online that the dollar could suffer a sharp decline in value in the not too distant future. And I want to ask both of you the basis for these concerns.
Okay, well, if you don't mind, Jim, I'll lead off and just mention that the ICE US dollar index, which measures the dollar against a basket of currencies from major trading partners like Japan and the Eurozone and so on, has fallen below 90 this week, which is near a multi-year low. The value of the dollar is being threatened by inflation concerns, an explosion in the amount of U.S. debt, reduced faith among some foreign national central banks in the greenback as a result of the Federal Reserve's ongoing loose monetary policies, and excessive borrowing by the federal government. And it's perhaps this latest concern that's probably the one that's having the most effect at the moment. You know, the national debt is now well over $28 trillion. The debt to GDP ratio is now 128%. And the situation is probably going to deteriorate further as a result of the spending projects that Biden administration is currently to try and push through Congress. The estimates I've seen peg the debt maybe well over $30 trillion by 2025. But there's other factors that are impacting the dollar too, and one of them is a good thing. You know, the approaching end of the COVID-19 pandemic, which many are thinking will lead investors to step back from relatively safe assets such as U.S. stocks and bonds and look at currencies outside the United States. And if we look at the international markets, we'll see, the U.S., let me say this, the U.S. fixed income market, yields on a 10-year treasuries are about 1.6%. Now that is higher than most developed markets, but significantly less than the 3% or so that investors are getting paid from Chinese and Mexican bond equivalents. So all this put together has put pressure on the dollar over the last few months.
Yeah, my view on the dollar starts by looking at a longer history of the U.S. dollar index. And if we take that as sort of a framework, what we find is that while the dollar has been weak over the past year or two, compared with where it's been over the last 40 years, it's sort of still in a middling range. And I expect the dollar probably will be under a bit of pressure for the foreseeable future. It wouldn't surprise me if we get down to maybe even the mid 80s on the U.S. dollar index. But that would still leave it well above the lows we saw back in the financial crisis in 2008. The prospect of higher inflation, government spending, and some other factors will probably keep it weak for the near term. But I think it's important to recognize that the dollar, first of all, like every other currency and commodity, over the very long term, it tends to be a 0% return on it. It fluctuates, but never really goes anywhere. And that's certainly true of currencies. Question for the dollar, of course, is there some sort of major regime shift underway here? And anything's possible. I've heard that the using the dollar as a reserve currency for the global economy, the jig is up. I've been hearing that for years and years. But it's important to think through what would be required for that to happen and trigger a much weaker dollar scenario. And the dollar. The question is what would replace it? I mean, the obvious options are no less problematic than the dollar, and in worst cases, in some cases. I mean, the major currencies are the euro and the yen. The yen for the Japanese economy, they have a much higher debt to GDP ratio than the U.S. I mean, maybe that's going to change, but at the moment, U.S. looks like the worst kid on the block. I mean, there's the euro as well, but the euro has all sorts of issues that some people say the euro won't even last another decade. But so the question is if the U.S. dollar is no longer going to be the reserve currency, what's going to replace it? I mean, to some extent, that diversification has already happened. It's moved into gold. It's moved into euro. I mean, the big one is, of course, the Chinese yuan, but China's still a relatively closed economy. And so using that as a reserve currency just doesn't make practical sense anytime soon. So, yeah, on a tactical basis, I'm sort of a short-term bear on the dollar, but expecting it to head through the lows we saw a decade ago, I'm still need to be convinced.
Andy, what do you think would be your counter argument to that?
Well, I agree. Jim is right that it's very a clear alternative to the dollar as a reserve currency hasn't really arisen yet. There is some talk about Bitcoin or other cryptocurrencies becoming a alternative. We can talk about that a little bit more. I'm skeptical, but then again, just last week we had the division chief for the International Monetary Fund coming out and saying a world with more than one reserve currency is a more stable world. And there's been a long time, a long discussion of having a basket of currencies replace the dollar, and I think that is a feasible alternative as well. But all that being said, there are, I think, other arguments that one could assert will keep the dollar from falling precipitously. First is that the economists are forecasting the U.S. GDP will grow about 6.5% this year, as compared to an average rate of growth of around 5% for other developed economies this year. And so, a strong U.S. economy ought to attract, I think, sufficient global capital to easily finance the current external deficit we have, which would be supportive of the dollar. And, higher economic growth means more profits for U.S. companies and higher inflation, both which could be supportive of the dollar. And then on top of all of that, you have the fact that U.S. debt is denominated. Let me say this: U.S. debt is denominated in dollars, and much of that is held by other countries like China, and so China is not going to want to see the dollar lose a huge part of its value. And finally, a decline in the dollar makes imports to American consumers more expensive, and therefore you're going to have some pressure to keep that from happening, not only from the People's Bank of China, but also the World Monetary Fund, who's going to be worried about how a falling dollar might adversely impact emerging market countries. So while I guess what I'm saying is I believe the decline of the greenback will be gradual and could extend over several years, but I wouldn't be surprised at all to see it fall below what Jim is seeing as, sort of a floor of 80 something on the index. I think there's a risk that over a longer period of time that clearly could happen.
Yeah,
and mainly because of increasing currency.
Some of this is also related to relative interest rates. It's useful to point out that the U.S. 10-year yield is still way above Japanese 10-year and German 10-year. So the relative attractiveness of U.S. assets from a safe haven perspective is still quite huge, and that will help prop up any weakness in the dollar, perhaps to some extent. And if, as you point out, Andy, if the U.S. Economy is hotter than it has been based on some of the stimulus spending and the rebound, and if the economy heats up over what's going on in Europe and Japan, that is also going to be sort of a bullish dollar situation, because it may eventually force the Fed to raise interest rates more than or quicker than expected. So there's a number of factors here that I think ultimately are going to end up as a wash. I'm tactically, I think the dollar is going to probably trend lower for the foreseeable future, but I don't see any kind of calamitous drop. And from an investment perspective, of course, the opportunity to take advantage of a weaker dollar is certainly quite intriguing, because if the dollar does weaken, that implies that foreign assets, after translating them back into greenbacks, are going to be quite attractive. So global asset allocation may finally ramp up in terms of what it's done in recent years.
Let's talk a little bit more about what a decline would mean for investors and consumers. Andy, what do you think that would do?
Well, if Jim's right and we just experience a moderate decline in dollar, that could be positive in that it makes imports more expensive and exports less expensive, as I said. And so that can be good for American good producers as their products become more competitive. But then again, there was just a very recent study that came out found that contrary to popular belief, U.S. equities tend to underperform the rest of the world when the dollar weakens. And one of that may be inflation, as it takes more dollars to buy goods and services. And these inflationary pressures reduce the temporary gains in competitiveness that come from the falling dollar. Another is that commodity prices move inversely to the dollar, and a rise in commodity prices can be hard on U.S. manufacturers. And it can also make U.S. real estate more expensive, of course, and which can be, of course, hurt the U.S. real estate market. So if the dollar declines moderately, as Jim is anticipating, but not a permanent situation, then I think it'd probably be, the equity markets would be fine. If it becomes a more serious long-term problem, which I'm not predicting, but I think is a distinct possibility that we have to take into account, especially if we continue the path where we're on, apparently there's a large school of people who think that deficits don't matter and that debt doesn't matter for a country like the United States. And I just have a hard time accepting that premise. And if debt does matter, then at some point the dollar is going to be hit hard. Where we reach that point, I can't say. But in my view, the dollar will be hit hard if we just continue down the course we are on. And so far now, with this big infrastructure plan and other things, it doesn't seem like there's any will in Washington to change direction.
Yeah, it's also important to point out too, though, that if you're right, Andy, and the dollar is weaker than expected, one would expect that something along the lines of the Plaza Accord, where central banks a couple decades ago got together and decided they were going to prop up the dollar, that could come into play again too, because it's not really in the interest of central banks for there to be excessive volatility in currency trading. So if the dollar is much weaker, that implies that the euro and the yen will be much stronger, and those are definitely not scenarios that either economic bloc wants to see. So there is a interest in around the world for the major trading partners not to let the dollar decline get out of hand. And
No, I agree. You might, and I mentioned that earlier, right? When I talked about the fact that China holds so much U.S. debt, and other countries do too, and so much debt is even non-U.S. debt is priced into the dollar, right? So is priced in terms of the dollar. So yeah, you're right. There are reasons to believe that the dollar has a lot of support, a lot of different things that would help hold it up. But that doesn't change the fact that at some point you just go too far. And, we weren't dealing with a $28 trillion debt level when the dollars, when those accords were reached. We've entered into, in my mind, an entirely new scenario, one that history does not provide a meaningful example. And so, I'm not predicting, Jim, that the dollar is going to collapse, and I'm not predicting that the dollar is going to move away from the world currency anytime soon. What I'm trying to say is that there are consequences for debt, and there are consequences, for the U.S. incurring debt, and one of those consequences is going or will be a decline in the value of the dollar if it continues at the pace that it currently is or anywhere near it. If we don't start addressing our debt levels and our deficit spending, I feel eventually the dollar will be hit significantly. I don't know if that'll be sooner or later. I suspect it would be later, but if from my standpoint, it's better to always plan for the worst case scenario, which in my mind is keeping the possibility of a declining dollar in your mind as you make investment decisions.
Jim, let me pivot back to you. Some have gone so far as to say that the dollar standing as the world's reserve currency is threatened as of right now, sort of similar to what Andy's proposing as a threat to the future. How do you feel about this?
Well, like I said, I don't think the structural forces are in play that would allow the dollar to lose its reserve currency status anytime soon. I mean, that's obviously an issue that is out there. It's been there for a while. But like I said, I mean, the euro and the yen are not great options to replace the dollar for a number of different reasons, which we can get into. But meanwhile, China is sort of the rising power, but the Chinese currency isn't a good option either because from an institutional perspective, a lot of reserve currency status is not applied there because it's a relatively closed system in terms of moving large amounts of money in and out of China, unlike what you can do with, say, treasuries. So structurally, that's probably not going to happen anytime soon. But on the other hand, there is a diversification. It's gradual going on. The dollar's reserve currency usage has fallen moderately over the past 10, 20 years, and it's gone into a little bit more of euro, a little bit more of yen, even some gold, even to some extent on a minor basis, the Chinese currency. But this is a gradual process, but I don't see anything, any kind of recurring situation as you had with the British pound a century ago, where almost overnight it lost its reserve currency status to the U.S. dollar. The forces that created that situation, which were very acute, are just not in play right now. I mean, that was a situation where mostly because of World War II and the decolonization of the British Empire and some other issues, almost overnight, the pound went from being a reserve currency to not being it. And so anything like that is probably not going to happen. As far as Bitcoin and cryptocurrency, I mean, that's really not a serious issue anytime soon because, when you're talking reserve currency status, there's a lot of money tied up into that situation. And, I think crypto is going to remain on the margins, an increasing factor. But if you're talking large institutional flows of money, I don't see anything beyond the U.S. reserve currency status is going to be sort of a slow, gradual decline over decades.
Well, if I could just jump in, Jake, for a second, I want, Jim's right, on a number of these facts, but there are indications that the situation with the dollar is changing, is in the process of changing. And perhaps the most dramatic of those is recent information from the International Monetary Fund, which shows that central bank reserves of U.S. dollars has fallen to 59%. And that's a 25-year low. So we've already started this, transfers, or the dollar's already beginning to lose status as the world currency, as evidenced by the fact that central banks are becoming less and less confident in the dollar as a store of value. And that's the number one thing that a reserve currency has to provide. It has to be a store of value. And for that reason, I do agree with Jim that Bitcoin or any of the other cryptocurrencies aren't a serious threat today because they're just too volatile. They're more of a speculative investment than a store of value. So it's also, I think, another thing that supports Jim's point of view is that it's important to keep in mind that America's economic and military might is a major reason for its position as the world's reserve currency, right? Of course, cryptocurrencies have no such government backing at all, much less by the most powerful military and economic force in the world. So I don't think it's going to happen overnight, but I think there could be an ongoing transition, and I think we're seeing that process has already started, and that I think that transition could accelerate if we continue down this course of massive deficits and debts to other parts of the world. Well, I'm afraid to say, guys, I think that's about all. This is a fascinating discussion, and I thank you, Jim and Jake, for joining me. And I'm glad to see that, I'm glad our audience can see that there isn't exactly always a complete meeting of the minds here at the Milwaukee Company, but that's good. I always try and foster difference of opinions. I think that's where you get how you make your best decisions and come to the best conclusions. So I enjoyed our conversation today very much, and I want to thank you, and I also want to thank our audience for joining us. I want to remind our audience that they should please keep in mind that how important it is to conduct your own independent research before acting on any information or opinions expressed during this podcast, and that they should not act on anything they've heard in this podcast until they have discussed it with a qualified financial professional who's familiar with your personal situation and investment objectives. And with that, I'll wish you all a good day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.